All right, here we go.
Not?
Yeah, I start recording. Yep.
Okay, yes. Hello everyone. Welcome to Accounting Design Project workshop. Today's topic is lease accounting. There are two presentations in today's workshop. Each presenter will have 45 minutes. And the presenter will be give 5 minutes uninterrupted time. So let's start with Derek. Derek is a 5th year PhD candidate at the University of Wisconsin. He's on the job market this year and presenting a component of his dissertation about the international benefits of the dual classification system for leases. So over to you, Derek.
Thanks, Sue. Let me get my slides all set up and then hopefully we can get going. Okay, Sue, can you tell me if you can see those? Okay, perfect. Well, anyways, first of all, thanks for the introduction. I am excited to be here, and I just want to say, first and foremost, a big thank you to everybody who helped organize this sort of event series. It's been a lot of fun. I've spent a lot of my Tuesdays in the last month and a half listening to cool research on topics that are relevant to practice, which I think is something that's exciting, and hopefully we can get more people interested in that type of research. So I am presenting my paper, An Evaluation of the Informativeness of the Dual Classification System for Leases today. And like Sue mentioned, it's one of the components of my dissertation. And so in this paper, I am interested in investigating whether the dual classification system that distinguishes between finance leases and operating leases is informative to equity investors. And to appreciate why that question is important, it helps to know two things. First, we need to know what the dual classification system is, and then it also helps to know a little bit about the history of lease accounting, both in the United States and internationally. So the dual classification system is the accounting rule that requires firms to distinguish between finance leases and operating leases, where the lessee bears less of the ownership risk for an operating lease, and they bear more of the ownership risk for a finance lease. And so before the most recent updates in the accounting standards for leases, both IFRS and US GAAP required firms to apply this dual classification system. And once they distinguished between a finance or an operating lease, firms would report an asset and liability on the balance sheet for finance leases, but for operating leases, they would just disclose the minimum amount of payments that were required by their contracts for operating leases in the notes to the financial statements. And so in that environment, in 2005, the SEC issued a report to the president and members of Congress in the United States. And in that report, they estimated that United States filers had roughly $1.25 trillion committed to operating leases that were disclosed in the notes, but there were no corresponding asset and liability on the balance sheet. And so if everybody remembers what was going on in 2005, this was right off the heels of things like Enron, WorldCom, that were centered about these accounting frauds based on off-balance sheet financing. And so that $1.25 trillion number made a lot of people in Congress, and especially the president, really nervous. And so in response to that report and the SEC's recommendation, the IASB and FASB added leases to their agendas as part of the convergence effort. And the sole goal of this project was to get assets and liabilities on the balance sheet for all lease transactions. Then in 2010, they issued their first exposure draft. And in that exposure draft, they were going to require firms to recognize an asset and liability for all transactions consistent with their goal. But they also proposed to remove the dual classification system entirely. So firms would no longer distinguish between an operating lease or a finance lease. Every lease would be treated the same from an accounting perspective. And in response to that report, the board has got a lot of negative feedback from certain user groups, particularly suggesting that not distinguishing between finance and operating leases could conceal some very meaningful economic differences between the two different types of lease contracts. So 3 years later, they took that feedback and they issued a second exposure draft. And again, consistent with their goal, they proposed to have assets and liabilities for all lease transactions. But in this exposure draft, they were going to retain a dual classification system. So firms would still distinguish between two different types of leases. Now, they must have heard feedback from different user groups and different constituents, because they also got a lot of negative feedback for this proposal. And particularly, there were a lot of preparers and some investors that felt the benefits from distinguishing between two different types of leases was not enough to justify the costs. And a lot of preparers voiced concerns about the costs of separately accounting for and tracking these different types of leases. So at this point, the boards were in a bit of a pickle. It had been 7 years, and they knew they were going to put assets and liabilities on the balance sheet, but they really had no clear direction on what to do with lease classification. So 3 years later, they ultimately issued their final accounting standards. So the IASB issued IFRS 16, and the FASB issued ASU 2016-02. And both of these standards, as they intended to, now require firms to report an asset and liability on the balance sheet for all lease transactions. However, ASU 2016-02 retained the dual classification system. So in US GAAP, firms continue to distinguish between finance and operating leases, and then that leads to differences in accounting on the income statement. Under IFRS 16, firms no longer distinguish between two different types of leases. They treat all lease transactions the same. And ultimately, despite their original goals of converging, the boards cited different comments that they received from their specific constituencies to sort of justify this divergence. So particularly, the FASB pointed to comment letters that they got from preparers that suggested the differences in the underlying economics of lease transactions, both in terms of risk, bankruptcy, and tax treatment, are useful enough that can provide information to investors that justify the cost. The IASB, from their constituency group, did not get a lot of consistent support for those differences being all that informative. And one particular reason is the IASB is responsible for setting standards for countries across the globe. So any of these differences in bankruptcy and tax treatment may vary across these countries, making it hard for them to rely on those as a justification for keeping the system. And so with that in mind, just jumping back to my research question, why I think it's important. First, it's ex ante unclear whether or not the system is informative. So the board spent 10 years, the whole time they knew they were going to put assets and liabilities on the balance sheet. They just didn't really know what to do with lease classification, and ultimately they couldn't even come to the same conclusion. So it seems like there's room for us to learn here. And then on top of that, if the system is informative, the IASB may have degraded the usefulness of their financial reporting by removing the system. But if it's not informative, the FASB may be imposing these unnecessary compliance costs on their preparers. Yeah, Young.
Hi, Derek. Can you tell us a little bit more about in the US, how does the bankruptcy law actually distinguish different types of leases? So like whether it's a kind of like is a purchase with financing, or is actually a lease contract? Do they use any black line threshold, or what approach does the courts use to distinguish two different types of leases?
Yeah, definitely. Great question. So you beat me to it. So thank you for helping me move along. So
okay.
Yeah, the idea is that in certain countries, the US being one of those countries, bankruptcy law will distinguish between different types of leases in a manner that's aligned with accounting. And so to the extent that that distinction for bankruptcy is aligned with accounting, knowing what the distinction is for accounting tells you something about the treatment of leases in bankruptcy. And so sort of to your question specific to the United States, in the US, if a lease is a finance lease, it's really likely that it's going to be a finance lease for bankruptcy purposes, because those distinguishing criteria are highly correlated. And for a finance lease in the United States, it's treated as if it's a secured borrowing. So it enters bankruptcy proceedings, and the ultimate payments that relate to that lease are subject to the negotiations of the firm, all its creditors, and the bankruptcy court. Now, for an operating lease, it doesn't enter those bankruptcy proceedings at all. So firms have two choices. They can either keep the lease and continue making payments, or they can return the asset to extinguish any obligations that they have.
Are there examples that whether the court actually used that pre-A42, for example, 75% of the useful life or 90% of the fair values, or it's just a conceptual high-level distinction between two different type of lease contracts, but each court actually can decide how do they classify based on their own matrices?
Yeah, so the courts do have bright line thresholds. Now they don't point to the accounting rules. That's pretty rare across countries as far as I've seen. Now I haven't looked at every country, obviously, but they do have very similar thresholds. So for example, in the United States, one threshold is if the lease term is 75% of the economic life of the underlying asset. That's one criteria in the old environment that you would use to classify a lease as finance. Bankruptcy courts.
That we can exchange literature. The cases I saw actually has a much higher 95%, very close to 100% when they classify a lease as a secure borrowing. Yeah.
Oh, okay. Interesting. Yeah, I would love to hear, read what you said, because the rules I saw were a lot closer when I read through the distinction. And maybe there's probably some subjectivity in there with the court, but at least as a starting place, the rules I saw were not, they were slightly different, but they were a lot closer. So if you could send me some of that, that would be awesome. Yeah, if you get a chance. Yeah, I appreciate that. But anyway, so when I'll jump into sort of the theory underlying why this thing could be informative, since we're talking about it already. But just quick before I get there, an overview of what I find. So I find that in countries where bankruptcy and tax law distinguish between finance and operating leases in a manner that mirrors accounting, the dual classification seems to be informative to investors. But in countries where the dual classification system doesn't have those distinctions for bankruptcy or tax purposes, I don't find any evidence that it's informative. And so jumping into the theory quick. So we touched a little bit about why it could be informative to distinguish between these different leases for bankruptcy purposes. Two other reasons that the literature sort of points to for why it may be informative. First, it can tell investors potentially something about the underlying risk of firms' leases. And the reason being is the defining line that the dual classification system uses to distinguish between finance and operating leases is based on ownership risks. And so to the extent that firms are distinguishing between leases where they have more ownership risks versus leases where they have less ownership risks, that can signal some information to investors about the underlying risks of those leases. And then that can ultimately inform about sort of the uncertainty of future cash flows for a couple reasons that the literature suggests. So the first is that when you bear more of the ownership risks, the firm's going to be exposed to more changes in the underlying value of the asset. And those changes in value are subject to these uncertain forces like wear and tear, technological advancement, which is going to increase the uncertainty of the firm's cash flows for those leases. And then second, in response to these uncertain economic shocks, the cost of adjusting capacity is going to be a lot higher for finance leases because they're much more akin to in substance transfers of ownership. So if you have some sort of restructuring that's going on, you have a negative shock to demand and you need to reduce your assets, it's going to be much more costly to do that and take more time if you have finance leases compared to operating leases. So just quick refresh on the bankruptcy, potential bankruptcy information the system can provide. So like Ayang and I were talking about, in a lot of countries or certain countries, the bankruptcy law distinguishes between finance and operating leases in a manner that mirrors accounting. And those distinctions lead to very different or meaningful differences in treatment in bankruptcy. And so having that distinction for accounting can inform investors potentially about the firm's cash flows in bankruptcy related to those leases. And then last is the taxable income information, and that's very similar to the bankruptcy signal. So in certain countries, tax law distinguishes between finance and operating leases in a manner that mirrors accounting. And particularly for the tax information, generally when that distinction occurs for tax purposes, the pattern of deductions for taxes mirrors the pattern of expenses for accounting purposes. Now it's obviously not perfect. There's things like accelerated depreciation and whatnot, but it's much more aligned than it would be if you had an operating lease for accounting that was then a finance lease for tax purposes. And so because there's that nice book tax conformity, that actually reduces these book tax differences that investors would need to use to get to taxable income. And there's a big literature in like the mid 2000s to early 2010s that pretty consistently finds evidence that investors struggle to interpret and understand the information that's embedded in these large book tax differences. So having that nice conformity under the dual classification system helps reduce that additional complexity that investors have to go through to figure out the firm's taxable income. Now, of course, yeah, Ken.
Could you please just clarify again the taxable income effect here? Is it the case that if it's viewed as an operating lease, that it is taxed as an asset with depreciation and interest cost in the US? I mean, in my setting, it's always viewed as rental expenses, even though it might be accounted for capitalized, and operating lease is capitalized. But is this different in the US? Question.
Yeah, that's a great question. So thanks for saying that. Yeah, in the US it is different. So if it's a finance lease for accounting, again, they have their own classification rules. And actually in the UK's tax law just points to the accounting rules. So in the UK, the classifications are perfectly aligned. But in the US, it's very similar rules that distinguish between the leases. And if it's a finance lease in the United States, it's treated as if it's a sale. So you have the lessee has the asset in their books. They recognize depreciation and interest deductions. But if it's an operating lease, they just deduct payments on a straight line basis for their tax purposes. And Ken, sorry, I'm going to ask you a question. Can you tell me exactly what country you're in? Because it's helpful to know some of the countries that have variation in this treatment. So,
well, I'm in Sweden.
Okay, perfect. Yeah, that's great to know. Because I started with all the countries that because I speak English primarily. So I started with those ones first because it was going to be the easiest to figure out what was going on. But thank you for letting me know. I appreciate that. Yeah, Young.
Hi, Derek. So just out of my curiosity, have you looked at the bankruptcy law or tax law before 1977, before the FASB actually introduced the dual classification, right? Because sometimes all those different agencies, we kind of like imagine they work really hard and create their best choices, but sometimes they just piggyback with the other agency's law, right? Like,
yeah.
What was the bankruptcy law and tax law before 1977, before FASB introduced a dual classification? What's the rationale for them to have the existing rules compared to changing to a dual classification?
Yeah, great question. And I need to look this up because you're now the second person to ask me this. Because essentially you're wondering, with chicken or the egg, right? Did bankruptcy do it first and accounting followed, or did accounting do it first and bankruptcy followed? I'm not entirely sure. So my hunch is that they were kind of developed independently, given that the rules aren't identical. And the other thing that makes me think, and if anything, I think the bankruptcy and tax law might have done it first, just because like lease transactions have been around forever, and this idea of that leases sort of fit in this weird sort of nebulous area where they're not really, you don't really own the asset, but it's not like just a pure expense. Like you do sort of have control of an asset. It's been a problem for like regulatory agencies, institutions, I'm assuming for quite some time, to figure out how to treat this, right? Because like bankruptcy law in the United States is pretty much set up around the foundations of, okay, who owns what and what money do you owe to people? And leases are kind of in some weird area in there. It's like, well, you don't really quite own it, and it's not exactly clear like how much money you owe, especially for like an operating lease when you could sort of just give it back. Mm-hmm. So I'm not sure. I will say in the UK, I do know that the accounting at least was, I don't know if the tax came first and then the accounting changed and then the tax changed to be like, we're just going to do exactly what the accounting says. But in the UK, it is perfectly aligned from a tax perspective. So the tax law actually just points to the accounting and says whatever the classification is for accounting, that's going to be what it's classified as for tax purposes. Now, when the accounting rule changed under IFRS 16, they put in a freeze on that. So they still use the old classification rules in the UK. But yeah, great question. And thanks for asking that. Okay, so with that, I'm going to jump into the unfavorable perspective. So obviously, if the boards diverged and one got rid of the dual classification system, there are some points to be made about why it may not be that informative. And so first off, there's a large literature that shows leases are clustered around accounting thresholds. And I'm assuming some firms also cluster their leases around tax thresholds, with the idea of at the margin, they're trying to make leases be whatever type that would result in the most favorable outcome for them. So for example, there's a few studies that show firms that prefer off-balance sheet financing for whatever reason are more likely to finance their assets using operating leases, consistent with these firms structuring leases that are near accounting thresholds to get that operating classification so they wouldn't have to report assets or liabilities on the balance sheet. And so to the extent that firms are sort of structuring these transactions, and there's a lot that are clustered around these accounting thresholds, the ultimate underlying differences in the risks that an operating lease or finance lease have may not be that different. So if you think we have, for example, one of the thresholds is if the lease is 75% of the underlying economic life of the asset, well, if you have a lot of operating leases where it's 73%, those aren't all that different from finance leases that are 76%. And so that can hinder the risk signal because it makes it hard for investors to rely on those distinctions to figure out what exactly the differences in ownership risks are. But that can also hinder the bankruptcy and tax signal. And we've talked about this. The bankruptcy and tax classifications generally aren't perfectly aligned. And so to the extent that you have leases clustered around these thresholds, that's going to potentially introduce noise in the classification signal that an investor could get about how the lease would be treated for tax or bankruptcy purposes. So for example, in the United States, for tax purposes, the threshold they use for finance leases is 80% of the underlying economic life as opposed to 75%. So to the extent that there's a lot of leases clustered in that 75 to 80% range, all those leases are going to be signaled with error. So they'll be classified as one thing for accounting, but maybe classified as another thing for tax purposes. And a similar logic applies to the bankruptcy signal. So then beyond the clustering, operating leases, although they bear less ownership risks than finance leases, they create these additional risks of their own. Particularly the most sort of forefront risk you can think about is recontracting risks. So I'm sure some of you own your house or took out a mortgage to buy your house, right? So the difference between renting and owning your house, you're locked into payments for like 30 years. Renting, you have to renegotiate what you're going to be paying each time you enter that rental market. And so you're much more exposed to these fluctuations in the market for leased assets if you're using an operating lease. And so for that reason, you have these additional recontracting risks. And so from that perspective, it's not entirely clear that operating leases, are less risky than finance leases in all respects. And so that can also hinder the risk signal. And then the third view, which is specific to the tax signal, there's a literature out there that argues that book tax conformity, especially full book tax conformity, is going to conceal information from investors. And to the extent that the dual classification system is increasing the book tax conformity for firms because the accounting aligns with the pattern of deductions for tax purposes, under that view, it could be actually concealing information from the market to the extent that those differences would lead to meaningful insights. And so that covers sort of both the perspectives on whether the system would be informative or not. So to actually investigate whether the system's informative and tease out the informativeness of each signal, I leverage 4 different countries, Australia, Canada, the UK, and the US, because they have this nice variation in which signals are provided in those countries. So quickly, before I get into the signals for each country, a benefit of using these 3 countries is They are all very similar in a lot of dimensions that prior literature has shown to have meaningful effects on sort of the implementation of accounting and how investors perceive accounting between countries. So first, they're all common law countries. They all have Anglo-Saxon origins. They all have premier security exchanges that are based on hybrid trading mechanisms. And they all rank really highly in those enforcement measures from like the 2000s. So like the Lopez et al., those type of measures, and they're all at like 20% or higher in those rankings. And for that reason, there's actually a few studies that have used these exact 4 countries to make comparisons on the basis of accounting or auditing. So that's one of the benefits of using these countries. And then, like I said, they all have this important variation in the signals that are provided. So in Australia, they only have the risk signal because bankruptcy law and tax law do not either distinguish between finance or operating leases or distinguish between them in ways that are very different than accounting. In Canada, you have the risk signal, but you also have the bankruptcy signal because bankruptcy law in Canada is aligned with the accounting treatment of leases in Canada. And then in the UK, you have the risk signal and the tax signal. In the UK, the tax law distinguishes between finance and operating leases in a manner that aligns with accounting, but bankruptcy law treats all leases the same. And in the United States, we have all 3 signals. So our bankruptcy and tax law distinguish between finance and operating leases in a manner that mirrors accounting as well. And so using that variation in which signals are provided, I use 3 cross-country comparisons to hopefully isolate the informativeness of each signal. And so the first comparison I make is aimed at isolating the risk signal. So as I just showed in Australia in the pre-update period, they only have the risk signal. But as you'll see in that box, I've added a last line. It's called estimation error. And so in the old environment under dual classification, when firms weren't reporting assets and liabilities on the balance sheet for their operating leases, investors had to estimate what they believe those assets and liabilities would amount to. But those were very rough estimations because they didn't have the specific details of each lease contract. It was very aggregated. And so they also had to make guesses about what the discount rate was, et cetera. And so that resulted in some estimation error that could potentially be confounding the differences within country in Australia. And so in the pre-period, you have risk signal estimation error. In the post-period, both those are gone because IFRS, which Australia applies, removed the dual classification system, which gets rid of the risk signal. But they also now require firms to capitalize assets and liabilities for all operating leases, which is going to reduce that estimation error. And so the within-country difference in Australia related to the lease accounting rules is going to be due to potentially the risk signal and changes in estimation error. The control for the changes in estimation error, I take the within-country difference in Australia and I benchmark it to the within-country difference in the United States. And that's because in the United States, the only thing that changed was the estimation error. Remember, we had all 3 signals in the US in the pre-period, and in the post-period, we keep the dual classification system in the US. So the only thing that is changing is the addition of those assets and liabilities to the balance sheet. So that's going to lead to that estimation error piece. And so the cross-country difference between Australia and the United States leaves me with the risk signal. Then to isolate the bankruptcy signal, this is the second comparison I make. So in the pre-period in Canada, we have the risk signal, the bankruptcy signal, but we also have that estimation error piece. In the post-period in Canada, all those are gone because Canada applies IFRS. So they lost the risk signal and the bankruptcy signal, but they also lost the estimation error because, again, assets and liabilities were added to the balance sheet for operating leases. And so that within-country difference in Canada is going to relate to the risk signal, the bankruptcy signal, and potentially estimation error. So again, to control for the estimation error, I take the within-country difference in Canada, I benchmark it to the within-country difference in the United States to control for that estimation error piece. And that cross-country difference with regards to lease accounting is going to relate to that risk signal and potentially the bankruptcy signal. And so to control for any effects related to the risk signal, I take that Canada to US comparison, benchmark it to the Australia to US comparison, which again was isolating the risk signal, and that controls for any effects related to that risk signal, leaving me with the bankruptcy signal. And Stephen, do you have a question? It looks like, okay.
Yeah, I hope I'm not interrupting you here, but I read just a little time ago that with the transition, with the capitalization operating leases, there is a lot more. I was really amazed by the figure of leases which have the annual payment variable based on conditions. Okay, and the number was very, very big. And so I just wondering how you think about that and how this could confound here, okay, in terms of that's a figure which gives, it's not on the balance sheet, it's risk, it's a risk aspect that you're taking on, how this might you might handle that.
Yeah, great question. So yeah, there are a lot of variable payments, and another thing that actually doesn't show up on the balance sheet is short-term leases that are less than a year as well. So those are things that wouldn't show up on the balance sheet even in this new environment. And so with regards to how it may affect the comparisons I'm making and the results I'm getting and the inferences I'm drawing, underlying this design essentially to control for that would be the assumption that on the average, the setup of variable payments to fixed payments between the countries aren't materially different. Now that I can probably figure out a way to test that. I haven't done that yet. But that, as long as that's true, these cross-country comparisons should be controlling for that effect. And really, I've titled this estimation error because that's where the emphasis has been from like the accounting standards, but that really should be picking up any differences pre to post that are sort of germane to all these countries, which would be things like that. So to the extent that that's a factor, by benchmarking across countries, that should hopefully control for that. Yeah, thanks. Sudipta.
Yeah, you were talking about sort of the enforcement earlier being comparable, but there's also litigation, and which is probably of greater significance. And it seems to me the litigation risk at least differs across countries, which would affect the estimation error because the incentives to report, even on the balance sheet, are going to be different across countries. So I don't know if you're fully removing the estimation error or not.
Okay, yeah, thank you. I appreciate that. Good to know. I'll dive into that. I do know some of the studies that I looked at that rank enforcement do have, there's like 5 and they all do a slightly different flavor. A couple of them do like securities enforcement, which a component of that is litigation. But I'll dive into those more specifically to really look into the particular countries to see if, not just on the aggregate, if they're similar, like what does litigation risk look like between the countries?
So I think those indices are looking at like SEC litigation as opposed to class action lawsuits, which are very different.
Okay. Do you know of anything that has like any research that's looked at class action things on a country by country basis?
Very long ago, Ball Kotari Robin did something like that, but it's like, so I don't know if anything.
I've read that one. Yeah, they do, but unfortunately, there's only one country in my study, so but yeah, thank you. I appreciate the comment. Okay, so let's see here. I think I was in the within country difference. So in the UK, that within country difference is going to relate to the risk signal, the tax signal, and estimation error. And so similar to what I do with the bankruptcy signal, I take that within country difference in the UK, I benchmark it to the within country difference in the United States to help control for this estimation error piece, leaving me with a cross country difference related to lease accounting that could be due to the risk or tax signal. And again, I take that cross country difference and I benchmark it to the cross country difference between Australia and the United States, which is aimed at sort of isolating this risk signal to help control for that risk signal. And then that leaves me with the tax signal. So those are the 3 comparisons I make at a conceptual level. So obviously I need to do this empirically. Well, I estimate 2 regression equations. This is the first one. And I estimate this first regression equation in a sample of Australia, Canadian, and United States firms. And so Canada is an indicator for firms incorporated in Canada. Non-US is an indicator for firms incorporated in the United States, outside the United States, excuse me. And then post is an indicator for observations that occur after the adoption of the new standards. And so with that setup, the second coefficient here, oh, sorry, that was backwards. The second coefficient is going to relate to that first comparison I make. So that non-US times post is going to be...
There's a comment in the chat.
Oh, yeah, perfect.
is the 5 years old schedules of payments remain under the single system? How do you
Yeah.
count it?
Yeah, perfect. Thanks. I see the comment, Joshua. So yeah, the 5-year schedule does exist under the single system. However, it doesn't distinguish between types. So you still disclose the minimum payments for your leases 1, 2, 3, 4, 5 years ahead, and then anything beyond 5 years ahead. But it's all just for one big bucket. It's just like, these are my minimum lease payments. Whereas before, under dual classification, you would have that schedule of payments, but it would be for operating leases, and then you would have a separate schedule for finance leases. So that's the key difference. Thanks for the question, Joshua. So quickly back to the actual equations that I'm estimating. So that second coefficient is picking up that comparison of Australia to US pre to post. And the reason being, having this Canada times post pulls out from that second coefficient any incremental effect that's unique to Canada. And for the same reason, that Canada post interaction then picks up the second comparison that I'm interested in, which is the Canada to Australia, or Canada to the US pre to post relative to Australia to the US pre to post. And so that picks up that loss of the bankruptcy signal. The second equation I estimate is in a sample of Australian, UK, and US firms. And so it's the same exact equation, but the only difference is I change out that Canada indicator for an indicator for firms in the UK. And so now that first coefficient, as opposed to picking up the bankruptcy signal, is going to be picking up the tax signal.
Hi, hello, Derek. Today there's a question for you.
Okay,
The
yeah,
comment.
great.
Do you know it? See it?
Yeah, I see
want
it.
to edit the last comments.
I can see it. I just pulled it up. Thank you for letting me know, Sue.
Okay.
Okay, yeah, thank you. I appreciate that, Judy. Not really a question, but thank you for letting me know. That's really helpful. So jumping back to the way that I measure information asymmetry is how I'm interested in figuring out if the dual classification system is informative. I use the average relative bid-ask spread at closing in the 5-day window around the release of the firm's financial statements. So a couple points on this. The reason I'm interested in information asymmetry is to the extent that these signals are informative, insiders or informed traders are still going to be able to observe these signals, whereas uninformed and outside traders are not. And so to the extent that it is informative, we should see this increase in information asymmetry. Now, the reason I choose this particular window is prior research suggests that in this window around firm disclosures is when adverse selection risk, which deals with information asymmetry, is going to be heightened. So I should have the most power to pick it up in this window. And this is the period when firms were disclosing that information before, and they no longer are now. And then a couple benefits of using relative bid-ask spread. So bid-ask spreads do have a concrete relationship with information asymmetry. And for that reason, it's been consistently used in accounting and finance to deal with information asymmetry in capital markets. And then another really helpful benefit in my setting that's a cross-country comparison is the determinants of bid-ask spread are really well known. So it makes it easy to control for a lot of things that may affect bid-ask spreads that aren't related to the accounting rule change. And so, for example, in some of my regressions, particularly the ones with fixed effects, the R squared is around like 75 to 80%, which is really helpful for controlling for these different factors. Yeah, Young.
Hi, I have one last question because you have 7 minutes left.
Yeah, thanks.
So one thing I wonder is that in addition to using cross-country comparison to capture bankruptcy signal differences, business risk differences, or tax differences, have you validated that indeed you capture those underlying risks across those countries? So like one potential way is doing the within country, the partition firms based on different sensitivity to bankruptcy risks, business risks, or tax risks, right? Do you see the same results when you actually hold constant the country jurisdiction, but firms differ only in one dimension of risks?
Yeah, so you're like my best friend for this, because that's basically the partitions I do. So I'll talk about that since I only have 7 minutes left. I'm going to quickly go over the results, and then I'll talk about the partitions I do.
Okay, perfect.
And then let me know if I didn't answer
Yeah,
any questions.
I saw like the table 7, so I'm not sure. Yeah,
Okay,
thank you.
yeah, great.
So
So,
Derek, you still have 5 minutes. Okay.
okay, yeah, perfect. So I'll quickly cover the results, and I'll do it really high level since we're running out of time. So I do find evidence that the loss of the bankruptcy signal seems to increase relative bid-ask spreads, consistent with an increase in information asymmetry, suggesting that that bankruptcy signal is informative. I do not find evidence that the loss of the risk signal has a similar increase in bid-ask spreads. And then for the tax signal, I also find that the loss of that signal is associated with an increase in relative bid-ask spreads. Again, consistent with this increase in information asymmetry, suggesting that that signal is informative. Now, to Young's point, cross-country comparisons, obviously there's a lot of stuff going on, right? And in my on average design, I'm really just relying on these differences in laws between countries. And so for my own sanity, I have done a lot of partitions. Now I only put 4 in the paper just to really help rule in that this is indeed related to lease accounting. And then within lease accounting, it's related to each of the signals I'm interested in. So the first thing I do is I successfully remove firms based on the intensity of their leases. So I drop firms that have leased assets less than 0.51%, 1.5% of total assets, and keep going until it gets too thin to estimate my sample. And the results show this nice positive trend with the coefficient that I'm estimating. And particularly once I've dropped firms that have less than 3% of their total assets as leases, it's roughly like a 3 times larger coefficient for the bankruptcy signal. And then for the tax signal, it's about 2.5 times larger. So that helps me feel good that it's the lease standard. Then really nail down the dual classification piece. I split my sample into firms that use 1 type of lease in the old environment versus firms that use 2 types of leases. And I find my results for the bankruptcy signal are concentrated in the group that have a history of using both types of leases. And for the tax signal, I find the same. So again, that helps me feel confident that, okay, it's really something to do with this actual distinction between leases. And then this is really specific to what Young was talking about. So to really nail down that it is indeed this bankruptcy information that's being conveyed, I split my sample into firms with an above versus below median bankruptcy probability. And I find that the results related to the bankruptcy signal are concentrated in that group that have above median probability of bankruptcy, which makes me feel comfortable that, okay, this is really picking up something that has to do with bankruptcy. And then for the tax signal, I partition my sample into firms with above versus below median changes in book tax differences upon adoption. So the reason I'm focusing on changes in book tax differences upon adoption is that the book tax conformity that was existing in the pre-period, once that goes away, the extent to which information is going to be lost in terms of figuring out what taxable income is going to be related to how big of a book tax difference that creates when you lose the dual classification system. Now, I'll be the first to admit this is not the perfect test because ideally I would like to look at changes in temporary book tax differences due to leases specifically. But I've looked through every single tax footnote disclosure of every UK firm in my sample, and only 2 of them said this is the exact amount related to leases. And so I just look at the aggregate change, but still consistent with this being something to do with the taxes and these book tax differences. The results are concentrated in the group that have this above median change in their temporary book tax differences upon adoption. Now with the first 2 fixed effect structures, it's kind of statistically weak, but with firm fixed effects, it gets a little stronger. So that covers all the cross sections. And I think, let me see, I've got 2 minutes left. So I'm just going to jump straight to what I think are the contributions. So I've taken a very practice focused approach in this paper. I've motivated the question from this practice central idea of they took a lot of time to figure out what to do and they ultimately diverged. So the biggest contribution I think this study makes is it provides some support for the ultimate divergence of the boards in terms of their lease classification. And the reason being is the IASB knew that they weren't going to be able to align bankruptcy and tax treatment, the bankruptcy and tax laws in every country with the accounting treatment, because those things vary for a lot of their different countries that they apply. And so when they had to focus on just the risk signal, my results suggest that that signal may not actually be all that informative, which provides some support for their decision to not keep dual classification. Whereas the FASB gets the standard set in the United States where those signals are there. They know they're there, and so they can rely on potential information that's conveyed by those signals. And consistent with those being informative and keeping the dual classification in the US, my results suggest it is actually helpful to have that distinction when you're in a place that has bankruptcy and tax law that distinguish between leases in a manner that mirrors accounting. And then just as the final comment that I'll say, I'm going to jump to one of the academic contributions that I at least like the most. So there's a big literature that has looked at cross-country differences in between countries and how that affects how firms, one, apply accounting, and then investors interpret accounting. Now, most of that literature looks at these broad differences, things like common law, English speaking, whether you rank highly in enforcement. And then they also look at these big, broad sets of accounting standards. So like IFRS or US GAAP. And so my study, at least to my knowledge, is the first that I'm aware of that takes this really narrow approach and looks at a very specific element of the regulatory treatment of a certain transaction and how that relates to the accounting treatment of the same transaction. And by doing so, I think it sort of extends that literature and shows, hey, at least in this setting, it seems that some of the reasons these differences exist is because accounting or investors use accounting rules to infer the legal and regulatory treatment. And I went like a minute long, but thanks for cutting me off, Sue.
Okay, thank you. Thank you very much for Derek's presentation. So next, we'll move to the second section. Next presenter is A. Yang. His title is Creditors' Liability Recognition Preferences, Evidence from Lease Accounting. So welcome, A. Yang. Over to you now. You are mute. Oh.
All right. Yeah. All right. Thank you, Derek. It's very interesting. I'm gonna kind of talk a little bit about the overlapped content in the beginning of my talk. So just very briefly, Derek gave a very nice introduction about the history about lease accounting. I would just kind of go a little bit backward, like right after World War II. In 1949, that was the first time the accounting standard in the US required long-term leases commitment to be disclosed in the footnote disclosure. So like what's the future lease payment commitment was first regulated in the US accounting standard. And the 1977 is the one I mentioned earlier, is that FAS 13 has this kind of dual classification, capital versus operating leases. And most of us have taught lease accounting. That's what we taught before 2019. And then there's a new accounting standard that requires all the long-term leases recognizing the balance sheet with two exceptions. One is short-term leases with the duration shorter than 365 days, or when the lease has a variable lease payment that is not dependent on publicly available indices. So like if your variable lease payment is based on unemployment rate, public available housing indexes, or CPI, then that still need to be recognized in the balance sheet. But if it's actually based on your store sales traffic, then that will be remain off balance sheet after this new standard. And this standard was affected in 2019. So what exactly is the disclosure? I think this is kind of related to Joshua's earlier point, is that before the new lease standard or under the dual classification, you see that capital lease, we recognize, for example, for Home Depot in 2018 fiscal year, they recognize 1 billion of the lease obligation, capital lease obligation in the balance sheet as a liability. But for operating leases, there's no liability recognized in the balance sheet. But we do see this disclosure in the footnote. And the challenge for external users, financial statement users, is all those future payments are up to 5 years. And afterwards, we don't really know. And to be honest, in our paper, we try to estimate the present value of the future lease commitment. We pick a number 8 and then apply to this all the future lease payment. And we also do not know the discount rate because they only give us undiscounted future lease payment cash flows. So we pick a number, and that estimate is not as accurate or precise compared to the recognition or recognized leases. And in addition to the different information content between operating and capital leases, according to Buffett, that even if the same number recognized in the financial statement versus disclosed in the footnote disclosure, auditors, internal, external auditors spend very different efforts confirming the number. Somehow recognized in the balance sheet is actually receive a stronger and stricter kind of like scrutiny and auditing efforts compared to just a pure disclosure. So the paper I'm presenting today is more about whether creditors consider some of the leases and recognize them as liability in the financial statement. Okay, so just briefly in the US, it may not be true outside of the US, but in the US, it seems like after 1977, most of the public traded companies try to kind of like restructure their lease contracts to be classified as operating leases. So if you look at the aggregate commercial real estate, commercial machinery, equipment, and automobile markets in the US, in 2022, the aggregate market size is about 455 billion. If you aggregate all the compute stat, undiscounted future lease payments under operating leases in the 2022 dollars is about 608 billion. But how about the recognized capital leases? It's only 33 billion. So at least in the US jurisdiction, most of the public traded firms structure their lease contracts as operating leases, and those are remain off balance sheet. And the capital lease is a very small fraction of the lease contracts they recognize in the financial statement. And that is kind of like the major motivation for the new lease standard after Enron in the early 2000. Okay, so in this paper, we mainly look at the debt contracts, and we focus on whether lenders actually recognize those off-balance sheet operating leases when they write those negative liability covenants. So liability covenants meaning that they want to actually put a limit on how much the borrower is able to actually obtain additional lease contracts, and they actually want to put a limit on that. Okay, so this is one example, is that Knight-Swift is one of the large US trucking company. In September 2017, they signed this loan contract to borrow 1.2 billion from a syndicated group of lenders. Those are Wells Fargo, Bank of America, and PNC. And in this contract, there's a negative covenant section. Indebtedness, there's a limit for how much they can actually enter into a capital lease contracts with other lessor. And they also specifically identify a indebtedness limit for operating leases. And this is how we classify this contract as including operating leases in the liability definition. It shows us that the lenders are aware of off-balance sheet leases, and also they put a limit on how much liabilities can be attributed to the limit through operating leases contracts. So in this case, they talk about like up to 2020, Knight-Swift can enter into operating leases up to 1.5 billion, and after that is actually reduced to 1.25 billion. So in this project, we go through those debt contracts, we review them one by one, and then to identify whether each contract includes operating lease limits or include them in the maximum leverage ratio covenants or not. And when we talk about recognition, whenever they're including them, we assume that they recognize operating leases in the balance sheet. Okay, so that's what I earlier asked Derek about the bankruptcy law in the US for leases, right? Because my reading from the law literature and some of the cases is that if Knight Transportation enter into a lease contracts with truck lessors, at the same time, Knight Transportation also have debt contracts with a bunch of banks. When Knight Transportation filed bankruptcy, those trucks actually are owned by those lessors and will be returned back to those lessors. And if not actually has any outstanding lease payment that's still owed to those lessors, those claims also come before those stepholders' claims. So in that sense, lenders should really care about whether their borrowers has signed a lot of lease contracts that actually create claims above and beyond their debt contract and claim to repay the principal amount of interest expense. And there's one legal cases, it's not about operating leases, but it's about omitted auditors and accountants omitted capital leases. And in the end, this lender, GSP Financial, lost money and is suing KPMG, which is the borrower's auditor who did not report the omitted capital leases. So in general, the message is that these omitted lease liabilities is actually a very significant matter for lenders, and we want to know whether lenders actually try to monitor this potential risk by designing their financial covenants, specifically including those off-balance sheet operating leases in the covenant liability definition. Okay. So what's this paper? We went through 7,000 debt contracts. We parsed from the SEC Edgar's website from 2014 and 2020. We picked that time period specifically around the new lease accounting standard. So later on, we can see whether that standard has any effect. And first, we checked whether those debt contracts are aware of balance sheet leases. They think that they all know about there's a lease agreement in addition to their debt agreement. 86% of them mention leases. 75% of those contracts talk about off-balance sheet leases. Surprisingly, most of them are aware of balance sheet leases, but whether they actually require to include off-balance sheet leases in their covenants liability definition, there's only a quarter of the contracts actually do so. The 3/4 of the contracts actually do not really put any limit on off-balance sheet operating leases limit covenant. Okay, so the next part of the paper is we try to understand why only a quarter of contracts bother to include off-balance sheet leases in the liability definition. And we kind of explored more than 30 determinants. And one thing kind of stands out is about the lender's past accounting fraud experience. So think about like Wells Fargo is the lender. And this Wells Fargo actually has a big loan portfolio, lending money to a variety of different borrowers. If there are other borrowers in Wells Fargo's portfolio had received SEC's AER or had restated their financial reports due to accounting fraud, or had reported SOX 4 for internal control weaknesses due to accounting fraud, Wells Fargo is more likely to change their contracts for the remaining borrowers to include or bring back those off-balance sheet leases in the liability definition. So that's kind of like what we find across different model specifications. And we also have placebo tests and also other tests to confirm that there's indeed an association that the lender's past accounting fraud experience is associated with their inclusion of off-balance sheet leases in negative financial covenant. Ken?
Question for clarification here.
Yeah.
I mean, if a firm is not, if a lender is not including this operating or long-term lease commitments in their liability definition, that does not necessarily mean that they ignore the liabilities that are connected here to leasing. I mean, they have other covenant measures like interest coverage ratios where this will be captured. So it doesn't mean that they ignore this, I would say. Because I mean, if you have these rental expenses and they affect your operating income and you talk about interest coverage, they will capture this type of risk.
Yeah, so like in the regression model, we do have like a rental expense. We also count how many different financial covenants they have. But in terms of when we manually review the contracts, we go through indebtedness covenants. We went through any investment related covenants that potentially were mentioned lease. We also went through leverage ratios. So we try to go through the entire financial negative covenant section, and then to see whenever leases are mentioned, we try to capture that. But there's of course some indirect monitoring, right? The potential interest coverage ratio indirectly also monitor the lease contract, but that's here in terms of our manual collection efforts. We only look for explicit lease related covenants throughout the whole session, not limited to only indebtedness or one type of financial contract. And later on, we'll talk about, there's a concurrent paper about rental expenses. So some of the lenders, they prefer cash flow accounting, so they don't really want a quote accounting that recognize liability. All they do is just apply a ad hoc multiple, like 8 times of the rental expense this year, and that would be your estimated lease commitment. So we are aware of that paper, so that's why we put the rental expense as a control variable. And then later I will show you that actually has some interesting observation in terms of a coefficient on that variable. Yeah. Derek?
Yeah, it sounds really interesting findings. The third one especially is really cool. Could you just explain a little bit behind like the logic of why having other borrowers have potentially indications of poor financial reporting? Is it that is the belief that like operating leases are kind of a proxy for other off balance sheet type financing, and so that's why they're bringing it back? Or
yeah, I think after the third point, my fourth bullet point and my following 5 slides are pure conjecture. Okay, and if I can do anything, that will be based on anecdotes and surveys, but it's very hard to actually go into a specific bank and then figure out what actually happened. But our conjecture is, let me go through our conjecture is when they design a project, before they experience those accounting fraud, their first priority is not to optimize accounting choices. There are other things they care more when they design debt contracts. It's only when they got burned by losing money through other fraud cases, that's the time they come back and rethink about those accounting choices. And off-balance sheet aggregation, like liabilities in general, will be something related to those general accounting fraud, and that's why they consider lease along with many other things. Yeah.
yeah, so just one quick thing, maybe in that vein, like if you read all these, did you see like there was other references to different types of off-balance sheet financing? I mean, that might be one way to provide some support for that, like just beyond operating leases, they talk about other off-balance sheet agreements.
There's a lot of off-balance sheet activities they talk about in contracts. Yeah.
Okay.
And those are the reason we pick leases is the easiest way to collect that information. And when I say easy, it's all relative. I can show you examples that those lawyers can write triple conditional terms that sometimes we need to read it for 20 minutes to figure out what's being included or excluded. So it's very convoluted in those debt contract design. But definitely there are a lot of other off-balance sheet transactions are mentioned and structured in those contracts, but it's just a lot more difficult for us to kind of standardize it in a large data set. Yeah. Okay. So the motivation for this study is that in 2022, yeah.
There's a comment from Joshua, who did from chat.
Joshua, do you want to unmute?
Yeah, he has comments in the chat. Do you know it? Could it be that easier to get out the operating lease, for example, by finding another leases? Do you find the message from the chat?
Okay, so Joshua is asking that could it be easier for lenders to get out of borrowers to get out? Okay, Joshua, do you want to ask that question or? operating leases?
So the question is, let's assume that you are a lessee in an operating lease and you want to break it. Is it easier to break an operating lease than a financial lease? Simply because you have less of an obligation and maybe you can find somebody else. So that may be the reason that they don't care so much about the operating lease.
You mean that lenders do not care that much about that
Yes.
operating leases because they can easily get out of terminate the operating leases?
Yes.
Okay, we need to think about that. And then we also have a sample of these contracts, so we can also take a look at how often, right, exposed those contracts are modified or canceled. Yeah, but that's a good point. We haven't thought about that.
So Ayong, this is Alvis.
Yes.
I think so. Your motivation is coming from, okay, when would the lender recognize these sort of leases in the contract, and you find that when the bank's borrower in the portfolio, they have run into more accounting problems, then for the focal borrower, they will try to recontract with them.
Mm-hmm.
Right. So this is, I think this is very interesting in the sense that, like, there are some studies looking at the consequences of accounting fraud or, this sort of like irregularity. But the focus is more on the equity side, saying that the equity investors, sometimes they might develop doubts about the firm that they invest in. Here you're looking at the lenders, and you can tie that to accounting. How this sort of concern from the other companies, because of their accounting events, that will lead the bank to recontract with the borrower, and you can tie that to accounting numbers and to accounting terms that they're actually focusing on. Probably, my guess is they are not only focusing on leasing per se. They might focus on other accounting issues as well. But at least you can, in your choice in here, we can tie that to explicit accounting actions that the banks are taking, and I think that is quite interesting, and that will help extend that literature. Because sometimes we don't know what investors are doing. Here you can actually see the actions explicitly in the writing of the contract, right?
Yeah, we can see the specific action in the contract. And then one thing we haven't explored right now is that we use the AER and all the analytics data. So we have not gone through individual cases to see whether this is actually indeed the accounting fraud in the SOX 404 or restatements or AER. That part we had not identified yet. Yeah. But for the contract, it's very specific. Yeah. Thank you, Elvis. Yeah, Ken?
You have a fairly strong conjecture here that the contracts are unlikely to be optimized. And perhaps you get back to that because it's a strong conclusion to say that your findings is indicating that they are not optimizing the contracting. So what kind of support do you have in order to say that the way that they act is not the optimal way, is basically my question.
Yeah, so like I think here the conjecture is indeed very strong, but and also very different from a stream of the studies later I will mention, is that most of the studies, when they don't see certain accounting choice is used in the debt contract, they assume that choice is not useful. So in this specific context, a lot of a contract actually talk about they are not going to explicitly talk about they are not going to adopt a new lease accounting standard, and the literature would conclude that then the new lease accounting standard is not useful for most of the debt participants. Our conjecture is that, wait a second, potentially they are focusing on other things that is more important than optimizing accounting choices when they design a contract. So as a researcher, we may not simply using the lack of use to assume that they have carefully reviewed all the accounting alternatives, and then they indeed think that any new standards or alternatives actually are not useful for their contracting purposes. Yeah, but still, I think I will show you guys some of the evidence, and then we have a lot of control variables, fixed effects, but still, we cannot really nail down to kind of like a specific priority list in their decision making when they write those contracts. Yeah, but I thought that Wei-Kwar may want to weigh in. Wei-Kwar has probably involved in some of those situations. Yeah.
Hi. Really good paper. I really enjoyed reading it. I just have two observations and related sort of suggestions, so to say. So analysts as a group are notorious for adding back such things, right? So I think your paper can kind of allude to their precedent in terms of what their objective function is and how that is kind of maximized vis-a-vis this case in which, okay, there is very low incidence of this happening. So I think some institutional background on why the banks are not doing it would really help the paper, I think. And one of them could be that it's sort of the mechanics of a right of use asset versus a liability is kind of canceling out, or is there a rental difference that is not moving the dial much in terms of the numbers for the covenants to change? So I think that prior would kind of silence a lot of such inclusions. I think more needs to be understood in terms of what specific covenants are affected. For example, tangible net covenant is very common. Tangible net covenant would not be affected if you include right of use asset, because right of use asset is an intangible, right? But then there will be other covenants that will probably be affected or not affected because you're just beefing up the balance sheet. So I spoke to a friend of mine who has implemented the standard and said what they anecdotally thought of 842 is the same as the goodwill standard. It means nothing for them. It's a store of value. And this is just beefing up again. But you're right, auditors pay more attention to verifying on-board hard values. So I think some institutional background in terms of what exact covenants are being affected or not affected meaningfully, irrespective of the beefing up of the balance sheet, I think that would give the paper a bit more substance.
Yeah, we can do. So like there are two covenants mainly are affected in our setting when we review it. The maximum leverage ratio covenant and indebtedness. So the limit on additional borrowing. Those are the two covenants. So I like your suggestion is that we can kind of like calculate it if we apply a multiple based on rental expense or other alternatives. How does this decision compare to using alternative covenants will really alter or change the inference, right? Elvis?
Yeah, so I sort of agree with the previous comment about like maybe you don't need to take a strong position on whether this is optimal or not.
Yeah.
It could be like, some cost and benefits trade-off. Because if the bank is not requiring the borrower to recognize the additional debt on balance sheet, is doing the borrower a favor. It's like allowing them a little bit more flexibility in terms of how they operate, whether they can take on additional leases. It's like to maintain their relationship with the borrowers, because at the end of the day, the bank is in the business of like retaining the borrowers, hoping to lend more to them, right? So there are benefits of doing that, and there are also costs of doing that too. If you try to enforce this, there will be monitoring costs, all kinds of things that the banks would have to incur, right? So at the end of the day, it might be optimal for them to just like forgo, without asking them to recognize it until it is needed. When it's needed, maybe like what you find when the concern is higher, right? So I think it might be like a cost and benefit trade-off in here.
Yeah, I think so. This is my first time working in the debt contracting field. So like one thing I'm still struggle with is when we talk about contracting efficiency, what's the objective of writing a contract for those lenders? What do they want to optimize? That is still something from reading the literature, I'm still unclear about. But in terms of relationship lending, we do see that our result is weaker for those borrowers and lenders has a past experience, so that the lenders already have lent money to the same borrower in the past. So it seems like if they want to maintain the relationship, this financial net covenants is not actually as important as maintaining this long run relationship with each other. Yeah. So we can take a look at that. And then I probably would talk to you more, Elvis, about what exactly are the different purposes that lenders want to optimize or want to achieve from writing those contracts. So our paper kind of focus on the contracting perspective. And then from the theory paper, I went through some of the recognition related theories. And you will see that US GAAP or any accounting standard usually would try to pick one alternative, but the market participants can, for example, lenders can decide whether they want to adopt the US GAAP or they can customize their own accounting choices. So in this paper, we are kind of evaluating lenders' choices in the debt contracts with respect to whether omitting some of the long-term lease liabilities from their definition or whether they want to include all the long-term leases. Okay. So briefly, kind of like related to what my conversation with Ken, how many minutes I have? Okay. I'm gonna jump very quickly. So like, when we kind of like look at those contracts, we tend to assume that managers or lenders optimizing accounting choices. But here at GSM, I just joined UC Davis. We don't have a department, so I got to see financing and marketing papers. And then sometimes in those papers, when they also analyze compute stat data from the same time period, they also assume that those managers at the same time are optimizing finance and marketing choices. But if we interview some executives, they usually cannot have a different priority list, right? It's impossible for them to optimize all those different decisions at the same time. Okay, so I'm going to jump very quickly. So in the literature, what we see that the lenders usually prefer EBITDA measure. They like something more kind of closer to cash flow accounting. They like to adopt this frozen gap clause. So whenever there's a new standards, they do not want to adopt it. Specific related to ASC 842, they say they don't want to adopt it in the contract. And they also use the rental expense as a way to estimate lease liability instead of using the present value of the future lease payment. Okay, and then I look at some of the comment letters submitted to the 2013 exposure draft. And in general, those lenders associations just complain and they don't really want the standard to be changed because they say they are going to actually change a lot of their current practice. It's very costly. Okay. And if you look at those contracts, who are those lenders? That usually there are 4 lead lenders are making the specific design in the covenants and then the other part of the contractual terms. There are other participating lenders. Who are those lenders? Usually those are the students we have taught in the classroom. They have undergraduate business degree, MBA or master in finance degrees. And based on my past probably 7 years of teaching, sometimes those students just do not really appreciate it. So that's kind of like our conjecture is that potentially they don't really appreciate it until they experience some negative damage through accounting fraud. Okay, so like we collect those contracts from the ACC and we kind of compare. There are 2 different samples. There are deal scan samples that most of the debt contracting researchers use. That is the bottom table. And then there's an upper table, which is our full sample that we collected from the SEC's website. So you can see that the deal scan samples tend to be bigger sizes. like larger deals. And those larger deals also have more indebtedness covenants or maximum leverage covenants. And interestingly, that the deal scan contracts, those are larger contracts, are less likely to adopt the new lease accounting standard, but instead, they actually customize their liability definition by including off-balance sheet leases in their liability limit. Okay, so that's something kind of new to us because the prior literature tend to look at floating versus frozen gap, and then concluded that whether a new lease or new accounting standard is useful for debt contracting parties. But we find that if you go to the covenant definition in detail, very often they customize their own accounting choice instead of just adopting the standard as a whole. So especially for larger deals by the larger banks, they like to customize their own choices instead of adopt the whole package. And the following, let me see. Okay, so this is kind of like the count of, yeah, quick one.
Just wanted to clarify, when you say adopt ASC 842, is there a choice for them? I mean, do they have both type of leases? So do they have a choice?
Yeah, so
Right.
most of the contract in the US are frozen gap. Is at the time when
Right.
they don't adopt any new updates. They continue using the
So you're saying
historical.
adopt from a contracting perspective, not from a compliance.
No,
Understood.
not our clients.
Yeah.
Everything is in the contract here. Yeah.
Sorry, yeah.
Yeah. So most of the contracts do not use, well, not most, half of them. Yeah. So everything in this paper is about the contracting's perspective. We have not examined anything related to the borrowers. Okay, so like in terms of counts, that's the lead lenders on average experience AAR restatement related to accounting fraud and then internal control weakness. We also have a placebo test using like debt default restatements related to errors or ICF related to errors to see that if our construction of those shocks through lenders, other borrowers actually driving the results. And we remove that whenever there's an event from other borrowers that actually occur in the same industry with the vocal borrower we are examining, then we remove those shocks because potentially there's a like Enron, there's a spillover effect. One firm actually reporting a significant accounting fraud potentially related to the industry practice, and the all industry peers actually are reporting those frauds at the same time. Okay. So we include a lot of different determinants from the literature. So I'm going to quickly jump through the results. So the dependent variable is that whether to include off-balance sheet leases in liability. And related to those three different experiences, fraud experiences by the lender, we find this significant association, but the magnitude is quite small. That means that it doesn't take the lenders to experience multiple events before they modify the contract. And the most interesting models will be 4, 5, and 6 when we include the lead lender fixed effect. So if you think that some of the banks actually has lawyers to write those boilerplate contracts applying to all the different transactions, that should be absorbed by the lender fixed effect. So what's captured here is after they experience those accounting fraud events, they modify, they change the contracts subsequently. And in terms of the new accounting standard, it's kind of consistent with our reading of the common letters to the FASB in 2013, right after the announcement of the new standard in 2016. There's a negative kind of like sentiment regarding whether to include those off-balance sheet leases in 2017 and 2018. Okay. There are a lot of determinants we explored. I would briefly just talk about rental expense. So like a lot of banks actually use a multiple, apply a multiple to the net rental expense. And whenever they use that metrics, instead of using the indebtedness covenant related to our conversation with Ken earlier, then they are less likely to care about including off-balance sheet leases in the liability definition, right? So like Ken earlier, when you talk about the other covenants, if the banks are relying on to monitor the operating lease liabilities, for example, rental expense, then we should see a negative association with the inclusion of balance sheet leases in indebtedness or maximum leverage ratio. Okay. We also see that secure debt and those debts already has physical collaterals. So
Yeah,
like
5 minutes.
Yeah.
5 minutes.
5 minutes. Okay. So those debts, the lenders are less concerned about those risks because they already have the collateral. So there's also a negative association with whether to include those off-balance sheet liabilities. And the number of lead lenders, the more lead lenders they have, the more free riding problems, and they are less likely to customize this liability definition. We also run the interaction term to see specifically whether after the announcement of the new lease accounting standard, whether our results is altered. And it doesn't seem that this relationship actually differs before or after the introduction of the new lease accounting standard. We find weaker results related to Elvis' earlier point is that when the borrower and lender actually has a long-term relationship, that means that they have more than one transaction, one loan in the past, they are less likely to care about this specific accounting choice because they probably have other channels to learn about each other. And also we find weaker results for secure debt. We find stronger results when the borrower has a lot more operating leases remained off balance sheet, and when lenders has a lot more financial covenants. Those are the time when we see these effects become more pronounced. Okay. So we run this placebo test. What if other borrowers of the lender actually experience non-accounting fraud or debt default? We don't see that they change or modify this particular accounting choice in their debt contract. So it's not simply just something bad happened to the lender's other borrowers' portfolio. It actually has to be accounting fraud event specific to make them be aware of this off-balance sheet liability risk. And the debt contracting literature often use this frozen versus floating gap to infer whether a new standard is useful for debt contracting participants. So we also had collected this information that some of the contracts will explicitly talk about whether they want to adopt ASC 842 or not. And then we find that that is actually a distinct decision from whether they want to include off-balance sheet leases in the liability definition. So when the decision is whether they want to adopt a frozen versus floating gap clause, we don't see kind of like much interaction or significant relationship with our kind of other borrowers' shocks except for internal control weakness. So the internal control weakness, you can think about like potentially after experiencing those internal control weakness, lenders may have doubt about borrowers' information quality. But somehow this choice is very different, or in terms of correlation is negatively correlated with the choice to include off-balance sheet leases in liability definition. And then this, so in conclusion, that maybe it's a very, very strong conjecture that we still need to kind of find more direct evidence and also even like some within firm anecdotes about whether when lenders first design their contracts, do they actually seriously consider all the different accounting alternatives when they design those indebtedness or maximum leverage ratio covenants. And the second kind of like new message we learned from the paper is that the frozen versus floating gap clause seems to be a very different, distinct decision compared to the decision, the choice of including off balance sheet leases in liability definition. So we kind of like want the researchers in our field to be a little bit more careful when we infer usefulness of accounting choice. We do need to think about what the decision makers have in mind when they choose one versus the other choice.
Yeah, can I have a question for you?
Yeah, just a short one here. I mean, you're running these regressions here and you have a lot of independent variables. So then at the end of the day, of course, we wonder about what is the marginal R square of the kind of stars that you show here. I mean, are they explaining 0.5% of the movement on the left-hand side? Or what magnitudes are we talking about here?
Yeah, so for AER, the magnitude is very small. So it's like if they experience one event, they are likely to review and revisit the contract. For ICW, internal control weakness is probably 2 events in their portfolio. But still, those are very small magnitude, what we see on average. Right?
Yeah, I mean, I guess you see my point. I mean, if you have marginal R square explanations of below 0.5%, it's not so much to write home about because it's a very marginal explanation of a phenomenon.
Oh, sorry, Aya. Time is over. Okay, time is
I
over.
think we're over. Yeah, I
Yeah.
will stay here if anyone has more questions. And before you go, I want to kind of announce the next event by a student at Columbia. We'll talk about revenue recognition. Yeah.
Okay. Thank you everyone. For joining and participating these events. See you next time. Okay.
Anyone has questions for me?
Yeah, Young.
Oh.
I do